Earlier this year, the Bank of England issued a warning that the risk of a sharp market correction had increased. Stock valuations appeared stretched, particularly for AI-focused tech firms. The IMF managing director now says we should buckle up. U.S. debt interest payments hit $1 trillion per year, and multiple economists are saying the same thing. A financial crisis in 2026 looks increasingly likely. Now, maybe they're wrong. Maybe this time is different and there is nothing to worry about. But they said the exact same thing before 2008, and before 2000, and before 1929. The Economists had sent out the warning signs. Regulators had seen the underlying data. It was obvious an impending doom was coming, and everyone ignored them until it was too late. This video will cover what the last 3 financial crises looked like right before they hit, and how 2026 looks eerily similar to these previous iterations. Let's start with 2008, the housing crisis, because that's the one everyone remembers. In May 2006, JP Morgan warned clients of a housing downturn, especially in subprime housing. That's 28 months before Lehman Brothers collapsed. In August 2006, the yield curve inverted. That's a technical indicator that predicts recessions. It inverted 25 months before the crisis hit. In November, UBS warned of an impending crisis in the U.S. housing market. That's 22 months before the collapse for those keeping score. The warnings were everywhere. The data was clear. Housing prices had peaked. Delinquencies were rising. Subprime mortgages were defaulting at record rates. And everyone said the same thing. The housing market is strong. This is just a correction. The fundamentals are solid. They preached that till September 15, 2008, when Lehman Brothers filed for bankruptcy and $600 billion in assets vanished like farts in the Mongolian desert winds. The stock market crashed, banks stopped lending, and the global financial system nearly collapsed. But here's what people don't understand about 2008. It wasn't unpredictable. The signs were obvious years before. By 2006, 1/3 of all mortgages were subprime or no documentation loans. People were getting mortgages with no proof of income, no down payment, no verification. Banks didn't care if you could pay it back. They just bundled the mortgages into securities and sold them to investors. The average home cost nearly 4 times what the average family made. Historically, it was between 2 and 3 times. And mortgage lenders were seeing something they'd never seen before. People would close on a house, sign the mortgage papers, and default on their very first payment. They were underwater before they even started. The crisis was baked in by 2005. The collapse happened in 2008, 3 years of warning signs, 3 years of data showing the system was breaking, and nobody did anything. Why? Because everyone was making money. Banks made fees on every mortgage. Investment banks made billions on mortgage-backed securities. Homeowners saw their property values soar. Regulators didn't want to stop the party, so they ignored the warnings until the crash. The movie The Big Short goes into this, so I recommend you give it a watch. Now, let's go back further to 2000, and you'll see this pattern repeat, almost in identical fashion. In the 1990s, internet companies were the future. Everyone knew it. Stocks were soaring. Companies with no revenue, no profits, no business model were valued at billions of dollars. Pets.com, an online pet supply company, went public in February 2000, valued at $300 million. They spent $12 million on a Super Bowl commercial. The company lost money on every sale. It didn't matter. The stock went up anyway. In March 2000, the Nasdaq peaked at 4,058. Tech stocks had tripled in value in 18 months. And the warnings were there. Fed Chairman Alan Greenspan had warned about irrational exuberance in stock valuations in December 1996. That's 3.5 years before the crash. Warren Buffett refused to invest in tech stocks, said they were overvalued. People called him outdated, out of touch. The warning signs were obvious. Companies with no earnings, trading at 100 times revenue, IPOs doubling on the first day with no business plan, investors pouring money into anything with .com in the name. And then in March 2000, it stopped. The Nasdaq peaked, and then it fell. By October 2002, the Nasdaq had dropped 78%. $5 trillion in market value vanished. Companies went bankrupt by the hundreds. Thousands of tech workers lost their jobs. The same pattern. Warnings ignored. Obvious signs dismissed. Everyone believing this time is different. until it wasn't. And this tracks even as far back as 1929 with the Great Depression. In the 1920s, the stock market was booming. Everyone was getting rich. You could buy stocks on margin, putting down just 10% and borrowing the rest. Leverage was extreme. By 1929, stock prices had tripled from 24 levels. Price-to-earnings ratios were at historic highs. And the warnings came. Economist Roger Babson warned in September 1929, weeks before the crash, that sooner or later, a crash is coming. People laughed at him, called him a pessimist. On October 24th, Black Thursday, the stock market crashed. Panic selling. By October 29th, Black Tuesday, the market had lost 25% of its value. Banks failed, businesses closed, unemployment eventually hit 25%. The Great Depression lasted a decade, and it started with warning signs everyone ignored. You and I can see the pattern here. 3 financial crises, 1929, 2000, 2008. Each one had clear warning signs years before. Economists warned, data showed the problems, and each time people said, this time is different. So, let's talk about 2026. As I said in the intro, the Bank of England has warned of a sharp market correction. Valuations are stretched, particularly for AI-focused tech firms. The IMF managing director says to buckle up, citing full effects of U.S. tariffs, soaring stock market valuations, and AI-led euphoria. She said, history tells us this sentiment can turn abruptly. Banks in the U.S. and Europe have $4.5 trillion tied up with hedge funds and private lenders. That's 9% of their total loan books. The IMF notes that several major banks now have exposures to non-bank lenders that exceed their Tier 1 capital. That's the core buffer meant to absorb losses in a downturn. U.S. debt is at $36 trillion. Interest payments alone are over $1 trillion per year. That's 4.5% of GDP just on debt interest, higher than any other developed country. AI stocks have driven the market to record highs. NVIDIA, OpenAI, Microsoft, Apple, massive valuations based on future AI profits that haven't materialized yet. It's the dot-com bubble all over again. Companies valued on potential, not performance. And here's the kicker. An investment strategist at Dutch asset manager Van Lanschot Kempen said, if you think of a bubble of about 5 stages, we're probably in stage 3. Stage 3, that means 2 more stages before it pops. The parallels to 2008 are obvious, with banks being over-leveraged again and having massive exposure to private credit and hedge funds. If those funds start failing, the banks are exposed. Private credit is also now a $1.7 trillion market that is largely unregulated, riskier than traditional bank loans. The parallels to 2000 are also obvious, with AI stocks being valued on future potential and the massive investments in AI infrastructure. Companies are spending billions on data centers and chips, but the revenue hasn't caught up yet. And if it doesn't, those valuations will collapse. You get the point. So, are we headed for a crash in 2026? Maybe, maybe not. The warnings are there, the data's there, and even Stevie Wonder can see the vulnerabilities. But timing is impossible to predict. Here's what we know. Every major financial crisis in the last 100 years had clear warning signs years before that people ignored because everyone was making money, because this time is different, because nobody wanted to believe the cops were here and the party was ending. But the party did end. In 2008, it ended when Lehman Brothers failed. One institution. That's all it took. The system was so interconnected that one failure triggered a cascade. Bear Stearns, Merrill Lynch, AIG all fell in weeks. In 2026, what's the trigger? A major bank failure? A hedge fund collapse? A sudden drop in AI stock valuations? We don't know. But the system is fragile. The leverage is extreme, and the warning signs are everywhere. Is this time different? History says it's not. Subscribe, and I'll see you in the next one.